This is Edward Lambert, Effective Demand Research. And this is going to be maybe a really involved video because I'm going to show what you're looking at here is the Fed rate as it's moved through the Volcker recession and afterwards into the 90s. So that what you see here is how the Fed funds rate moved from the late 1970s to the mid 1990s. And I'm going to be explaining here what happened by using this monetary model of effective demand for natural interest rates. Okay, so down here at the bottom we have the utilization of capital and labor. Multiply those together, you get the TUFR, which is the total factor utilization rate. I'm going to use that as a measure of output and production as a percentage of labor and capital utilization. And on the side here is just going to be interest rates. This will be the Fed rate, interest rate, natural rates, just interest rates of various kinds. And then in here we have a whole garble full of all kinds of lines. How are we going to make sense of this? Well, we'll start with just the path of the nominal Fed rate. That's this crossing line in here. From the effective demand research, I have an equation to determine that. And we'll see that the Fed rate will follow this line at times, and at times it's on a whole different agenda. And then the natural real interest rate is this nominal rate minus the inflation target. You can see the inflation target up here. And then the funds rate is going to be this dark blue line right in here. This is going to be an important line to watch, because as we go through these dots, this blue line will cross through the center of the dot that's in question. So if you're ever lost and you want to know where the Fed funds rate is, just find this blue line, the solid blue line, find the dot that it crosses through, and you'll know where you are. And then you got the current inflation. That's this dashed yellow line here. So as we go through this, you're going to see the inflation going up and down, up and down. The real story in this is going to be as the inflation was going up, the Fed took control to bring inflation back down, and I'm going to show exactly how that happened. This has really been an interesting journey going through and figuring out how this all worked. And then this dashed brown line, the current real interest rate down here, that's just going to be the Fed funds rate minus current inflation gives you the current real interest rate. So if you just take that blue line minus the yellow dash line, you'll get the current real interest rate. And then this last line, the long run aggregate supply natural real rate, that's this diagonal that comes in like this. This is a key line to understand this whole process here. So if you want the natural rate or the natural level of GDP, real GDP, to be right here, this is the natural real rate that you want, around 3%. That's what this line is showing. But if you want to set the natural real GDP level right here, then you want to set the natural real interest rate level higher, say 6%. And that's exactly what the Fed did. I'm going to show a story of this, where the natural real GDP level was here, and the economy was hitting it. We'll see the economy hit this line 3 times in the story that I'm about to tell. But halfway through the story, the Fed wanted to control inflation. So they manufactured this new natural real GDP level here at this green line, and basically instituted a natural real interest rate of 6% instead of one of 3%. Which is an interesting story, and how they were able to do that. But by raising the natural real interest rate, by manufacturing a natural interest rate that was higher, they were able to control production, control utilization, and bring it from this higher level down to this lower level. And by doing that, they were able to control inflation. It's just amazing. Now, I'm going to start out with these dark blue lines, and you'll see, these dark blue dots. And this will be the trajectory. You follow this red line with these dark blue dots. It's going to go like this. This is the Fed rate going through in relation to capacity utilization times the employment rate. And then you'll see the green line come back up through here and stop here where the Fed controls it again at this point in time. And then it comes back around here, loops around. The green now turns into the pink dots. Pink dots come around and they come back up this line like they're supposed to, and they come right back into here, zero back in around, and stay here for about a year or two more, and the Fed comes right back to its target. It's amazing how the Fed was able to do this. They were able to control inflation and come right back to their target after about 15 years. Okay, so let's just start the story and get it going. Here we are. This is going to be the first quarter, 1978. And we're right here at this blue, dark blue dot. And inflation, we can see this is the Fed rate, this dark blue line, the Fed rate. It's just a little bit above inflation. We can see that the natural real GDP level is just off here to the side. So the economy is employing more people, employing more capital, and it's arriving to its natural rate. But we can also see that the current real interest rate here is below the natural real interest rate, this dashed blue line. So there's an inflationary tendency, there's an expansionary tendency. That expansion can come in the way of output or in the way of inflation. It depends on how the economy is set up to receive it. As you get closer towards this natural real level of GDP, the economy is less likely to receive it as increases in output and more likely to receive it as increases in inflation. That's what happens. Okay, so here we see, now I'm going to go up. Second quarter of 1978, so now we're at this dot. So from the first quarter to the second quarter, the economy rammed into the natural real level of GDP, which is interesting. It hit it really fast, from here to here in 3 months, and then stopped. But you can see even here that this current real interest rate is below the natural real interest rate, so there's still an inflationary tendency. So the Fed is at the natural real level, and they have built into their dynamics right here an expansionary policy. That's just going to start creating inflation. So now we come back, we'll go to the third quarter. We'll see that the current real rate stays low. Inflation starts to rise. The Fed rate starts to rise with it, trying to stay right up above it. But we still got, so you can see right here is where we are, we still have expansionary tendency between the current real rate and the natural rate. And then move on here to the first quarter of 1979. And we see that the current real rate is still staying low, and it's lower than the natural real rate. So there's still expansionary movement going on here, but the economy's not moving. Capacity utilization is not going up, employment's not rising. It's hit its natural rate. The economy wants to stay right here. So we see inflation starting to rise, and the Fed's trying to keep above it. But inflation is rising. Why is inflation rising? Because there's still the real rate is below the natural rate. Maybe the Fed at this point is thinking, let's push the economy farther and farther up. Let's employ more people, employ more capital. But then the economy hit its natural rate. So all that push for expansionary policy is going into prices and wages. All right, let's go to third quarter of 1979. So now we moved up here. Now the economy contracts a little bit, but inflation is still coming up. We can see down here, there's a little contraction going on because the Fed is raising its interest rate, its Fed rate. Now there's still some expansion going on here, and the inflation's still going up. The fourth quarter 1979. We can see that the Fed is trying to react now. The Fed has pushed up the Fed rate to here. Inflation's staying somewhat steady, and the Fed's trying to react to it. And you can see that the real rate has now risen to where it should be. So this is trying to stabilize. The real rate has come up to a stabilization point where it's the natural real rate of interest and the current real rate of interest are pretty much equal. So it's a stabilization point. It's not expansionary. It's not contractionary in its effects. So let's go on to the first quarter of 1980. Fed continues to move up, but inflation begins to move up too. Now if we come down this way, we'll see that it's still stabilizing. So in effect, what the Fed is doing right now is they're stabilizing a 12% inflation, because the real rate is stabilizing at the natural real rate and with this long run aggregate supply natural real rate of interest right here. All these three lines are coming together as a stabilization point. So in effect, the Fed is stabilizing at 12% inflation, which is kind of crazy. They think they got a control of it, but what they're actually doing is they're establishing 12% inflation as the norm, which is not good going forward. So they're trying to get control of this, and as usual, when you get to this natural level and the Fed starts to react, you're going to have a contraction. So now we go to the second quarter of 1980, and you can see that the economy's gone from here down to here. See that where the Fed rate now is right here, but the unemployment's risen and capacity utilization has fallen down to about 74. So you have this contraction. Inflation, though, is still rising. The Fed was not able to control it. Inflation is still rising. The real rate is way down here below the natural rate. So there's still an inflationary or an expansionary tendency in this dynamic. So let's go on to the third quarter of 1980. And the recession, this little recession from 1980 continues to its depths right here. And as we come down, we'll see that the real rate's fallen way below the natural rate. And that creates an expansionary. This Fed's trying to pull the economy back from recession. But look at inflation. Inflation is still way up there. And the Fed rate is below inflation. So inflation wants to take off from this point. So the Fed sits back and says, what are we going to do? And what do? Is an amazing thing. Look back here and look how this natural real rate of interest comes across here. Well, I'm going to move this black dashed blue line up here, like this. Now the real rate of interest, this natural real rate of interest, is going to be manufactured and held as target policy for the Fed right here at about 6% interest. They're going to start shutting down the economy with a higher natural real rate of interest. That's going to increase the cost of money. That's going to lower investment. That's going to make it harder for, it's going to just basically tighten money up and keep money tight. Raise the Fed rate overall as a target policy. And this is going to be a plan to start bringing down inflation. Now what it's going to do by setting this dashed blue line and this diagonal brown line coming down, setting that as the target for the economy, you're now going to set this about a little less than 75% of the total factor utilization rate. This is going to be set as the natural real rate of interest for the economy. Come back over here. All right, fourth quarter, 1980. This is the big, see that big jump? Let's go back and do that again. I want to show that to you again. See how that blue line went from here all the way up to here? The Fed has just changed policy. They've switched their target up to this higher target now. Now they're going to try and bring the real interest rate, this current real interest rate, up to this 6% and try and hold it here at 6%. And they're going to allow this dashed brown line as the current real interest rate as the hammer to bring down the economy. So right now it's come up to 4%. All right, inflation is still running high, 12%. Let's go to the first quarter of 1981. Inflation is still running 11% or so, but you can see the real rate now has come up to 6% and is hammering in the stabilization point on this new lower fabricated natural real GDP level. The Fed is manufacturing the stabilization point for the economy, and basically manufacturing this level of real GDP as the natural level with a natural real interest rate of 6%. So the Fed is taking control. And let's go to the second quarter of 1982. We see that the current real interest rate has gone up to almost a little over 8%. And this is hammering down on the economy. Inflation is still trying to count, still around 10%, 9.5%, and the Fed rate has gone up to almost 18%, so it's 17.8%. And as we can see, this brown dashed line is above the blue line, so this is very contractionary in its effect. Okay. So the Fed is hitting it hard. Now the economy would want to naturally go up to this red line here as the natural real rate, but the Fed is going to hammer hard on this line and try and keep the utilization of capital and labor, the multiplication of these two, at this green line. So let's go on. So now six months later, the Fed still has a high interest rate, high Fed rate, and they have stabilization. This diagonal line, the brown line, dashed brown line, and the dashed blue line are all crossing here and stabilizing this natural real rate. After 6 months, it's still stabilizing. Inflation is still high at 11% though. So the Fed still has a high Fed rate above inflation. They're trying to take control of it. But they go into the recession. The Volcker recession starts here as we come down this red line to here. And so after 3 months, inflation has come down 10% or so. Fed rates come down here, straight down from here. There's just a little bit of an expansionary effect left, but the Fed knows that the economy is going into a recession. 3 months later, even more unemployment, less capital utilization, and the effect down here where the brown line is above the blue line, that's contractionary. So the economy is still contracting. The Fed rate is still way above the yellow line here of inflation, so the Fed is still trying to control inflation. They still see 9% inflation as not acceptable. So even during this recession, they're going to be hammering down on it. Let's go 3 months later. Inflation still running around 9%. The Fed even raises the rate a little bit. Even as the recession is going on, they're trying to control inflation. And there's even a contractionary effect with the brown line above the blue line. 3 months later, the Fed drops its rate. It realizes it has to allow some monetary policy, or some aggressive or some loose monetary policy to start saving the economy a little bit, because it was just free falling. But luckily they saw inflation coming down, so that gave them a window to lower the interest rate. So, and even here there's a little bit of contractionary effect going on. Alright, so let's go to first quarter 1983. The depth of the Volcker recession. we can see here that the real current rate is still high at around 4%. Imagine being in the depth of a recession and you're holding the real interest rate at 4%. You're still hammering on the economy. You're trying to bring down inflation. And it's just amazing. This whole story is how even through these recessions, they kept the interest rates high to hammer down on inflation. So the Fed created this recession by by creating this new natural level of the real GDP, forced it down, and then they got the real interest rate up and the inflation down. This is still a little bit contractionary, but the economy is going to bounce back here. Let's go to the third quarter, 1983. Okay, the economy is bouncing back. Employment's rising. Capacity utilization's rising. We're right here. Still controlling it. The inflation's now down to 3%. So there's been a great job in getting the inflation down. And the real interest rate is high, so there's still a contractionary effect going on here. But the economy is bouncing back. Can't be down for too long. Alright, let's go to the first quarter of 1984. We're right here. First quarter 1984. You can see here that the brown line and the yellow line and the natural real rate of interest are all stabilizing right around in here. So the Fed is controlling it as the economy comes back to this fabricated natural level of real GDP. Not really natural because it's fabricated. As it comes back, they're still keeping control on the economy by keeping the Fed rate high. You can see it right here. Fed rate is high. And there's a little bit of an expansionary effect going on here. So they're controlling it as it comes back. All right, let's go to third quarter, 1984. And so as capacity utilization and the employment rate, as the total factor utilization rate comes back to this level where the Fed wants to control it, the Fed jumps up right here. They raise their interest rate to put on the brakes to try and hold the economy at this level. And why do they do that? Because they're trying to keep this brown dashed line at around 6%. That's where their new target is, to hold this real interest rate, natural real interest rate, where this blue line, this down sloping brown line, and this dashed brown line where they all meet, that's the Fed target. So as the economy came back to this point, the Fed raised their Fed rate to hold this target, and that would stabilize the economy at that level. And as you can see, what's happening is that the Fed rate is way above the inflation rate, so they're still hammering down on inflation. They're bringing it down, and they're holding the economy in a very, very tight position for a long time. They've set this 6% natural real interest rate here as the tight monetary policy target, and they're holding it, and it's working, and they're making the lines cross here, which is really fascinating. And so right now we're going to go to first quarter of 1985. Fed rate comes down, a little bit of a contraction going on here. So as the Fed jumped up here at this line, the economy contracted. A little bit of a expansionary effect. And now we're going to go to the third quarter of 1985 right here, just coming down. The current real interest rate staying low because there is sluggishness going on now in the economy. Now we'll go to the first quarter of 1986. Right here, still holding on. The economy is just kind of in a rut right now. Inflation's come down. The Fed has been pushing on it. Okay, now we come down to the third quarter, 1986, right here. So now the economy's the Fed is bringing down the Fed rate from here down to here. Inflation still around 4%. Current real interest rates around 2%. So there's an expansionary effect, so the economy is going to start expanding. As you can see, I'm going to go back 6 months here and show that the real interest rate here and the dash blue line and the dash brown line, there's just a little bit of a gap between them. 6 months later, there's more of a gap. So the economy is going to start expanding, or there's a lower current real interest rate compared to the natural real interest rate encourages borrowing. Going through it. Now we're going to go to the first quarter, 1987. We're coming right here. The economy is going to start expanding. Let's jump from here to here. The Fed is holding the Fed rate steady. 6 months later, right here. 6 months later, the Fed has gone all the way out to here, and the economy is expanding, but the Fed allowed the total factor utilization rate to break through this barrier. And when they did that, they did something very interesting. They now change their target back to here. Now their target's going to be here. They're going to shoot for this point here as far as the Fed rate, bringing the current real interest rate to this level. So when they allowed, see these green dots come down, when the economy began to expand back, they held the Fed rate steady and allowed the current interest rate to be to stay low. Okay, so let's go back. And we're going to go to the first quarter of 1988. Right here. So the economy is rushing back to this to the real natural real GDP level. This is the real one. This is where the economy really wants to be at. The Fed was manufacturing this one back here for many years. But now we see the economy's here, but the Fed this time has these two lines close. So the Fed has control. They have stabilization going into this natural real GDP level. If we go back to the beginning, you'll see that this blue line and this brown line, there was a gap. So as they were going back into this line, they had this expansionary policy going on. Now let's come back to the first quarter of 1988. Now you see that the brown line and the blue line are together. So they've controlled the expansionary effect going into this. So now we're going to go to the third quarter, 1988, to here. So the economy has come back to this natural real GDP level, right here, 1998. I'm looking here, this is almost 29 minutes. So I'm going to stop it and call this part 1, and then make a part 2 to finish the rest of the story where the Fed is actually able to bring the Fed rate back into perfect balance where they wanted it. Okay, that'll be in part 2.